So last time we were talking about fiscal and monetary policy, and I want to again go back to this. We finished fiscal but didn't begin monetary policy. These are two different types of economic policies, and they're policies that all governments in the world engage in one fashion or another. To repeat from last time, fiscal policy is generally made by the Congress. And fiscal policy simply is those government policies that raise revenues, we call usually those taxes, and make expenditures, spending. So taxing and spending is one of the key, perhaps the most important function of Congress, and we call this fiscal policy. Taxes can be raised or lowered and appropriated or levied across the population and the economy in gazillion different ways, and they're not all their impacts are not all the same, as we'll see later. And it can spend in whatever way it chooses. And so fiscal policy is one piece of economic policy. One of the things that's important to keep in mind is that in the United States, in the federal government, the people who make fiscal policy are not the same as the people who make monetary policy. There are different institutions involved. Fiscal policy is made primarily by the Congress, with some significant role for the president and his economic advisors. Monetary policy, however, is made by the Federal Reserve and the Open Market Committee. So the Federal Reserve, and so what is monetary policy? Monetary policy is policies that increase or reduce the amount of money or the money supply that the central bank, which is the Federal Reserve, provides to the American people and the American economy. It does this through basically, well, a whole number of methods, but largely three types of methods. First is changing interest rates. Second is bank reserve requirements. And third is open market operations, which is a fancy term for buying U.S. Treasury bonds. And in doing these three things, the Federal Reserve seeks to make monetary policy. So let's try to break down those three things because they're very important. And we can see to some degree the impact that monetary policies can have on the economy. The most obvious is changing interest rates. What are interest rates? Interest rates are very simply the cost of money. How many of you, raise your hands, how many of you have bought or leased an automobile? I can't see how many. Anybody?
Nobody.
Nobody. How about your parents? Probably most of them have, right?
Yes.
So, if interest rates, when you go to the car dealership and you don't pay cash for it, you have to borrow money in order to buy the car. Just like you have to borrow money and get a mortgage to buy a house. So, interest rates could be 2%. They could be 10%. The interest rate is the annual rate that you have to repay the amount that you owe. Very simply then, the higher the interest rate that exists in the economy, as set by the Federal Reserve, the more depressed economic activity will be, because it will be more expensive. If a business owner wants to expand his business or her business and interest rates are 10%, that's a lot more costly than if interest rates are 2%. Because the money that the person has to borrow can be either more or less expensive. The less expensive it is, the lower the interest rate, the more likely it is that people, whether they're businesses or households, will be willing to spend. So in changing the interest rate, either raising or lowering it, the Federal Reserve either stimulates or tries to tamp down the amount of economic activity in the country. Currently, interest rates are at historically low levels. The simple reason why is because and this is by no means a full explanation, is that the economy of the United States was on the brink of total collapse in the last year of the Bush presidency. Another way that the Fed makes monetary policy is through bank reserve requirements. This is the amount of money that the Federal Reserve requires banks to have in reserve for any number of financial purposes. It also may limit the amount of credit lending that financial institutions can do. On the other hand, the Fed can make it easier for banks and financial institutions to loan money when it gives money to the banks at very low interest rates, and banks then lend that money to consumers and businesses at a much higher interest rate. And so banks can make a good bit of money to the degree that there's a gap between what they have to pay the Federal Reserve for money, and then the gap between that and what they can actually lend it in the marketplace. And then thirdly, they can buy bonds. But the first two are especially important and more easily understood in some ways. Comments or questions? The bottom line then of monetary policy is that the Federal Reserve in the United States can make the cost of using money and buying money more or less expensive. The more expensive it is, and the less money, and the lower the money supply, the more that depresses economic activity. The lower the interest rate, the easier it is to borrow, the easier it is to get credit, the more stimulative of economic growth the monetary policy is. Any comments or questions? This is, in terms of the guts of domestic policy, really important stuff and not easily understood, but it matters greatly. So one of the things we've talked about with respect to fiscal policy is taxes. Taxes that are paid to the federal government. I wish I had a dollar bill for every time an American has complained about taxes being too high. I got news for you folks. Compared to other developed countries, the United States is the most undertaxed. We are taxed lower than Australia, Japan, Canada, Spain, Britain, Germany, Netherlands, France, Italy, Sweden. Our tax rate is roughly, in terms of what we pay to the national government, roughly half of what it is in Sweden, and in, say, Germany, it's 50% higher in Germany and the Netherlands, and goes up from there. Note that this chart looks at taxes collected as a percentage of gross domestic product. That is, the total value of economic activity in the society. So as a portion of the total economic activity in the country, the American people pay less than almost every developed country in the world. Are you shocked yet?
Yes.
Okay. So, and this is not new news. This has been the case for many, many years. And it's economists and social scientists and research is very clear on this. This is not an opinion. This is a fact. Still sticking with fiscal policy. Who pays taxes? What categories of entities pay taxes, and what are the kinds of taxes that are paid? So this goes back. This image goes back to World War II, up till about 2012, 2013. And what we see in the darkest blue in the bottom is a relatively stable percentage, hovering at or just above 40% of all federal tax revenues coming from individuals and households. It's a little on the high side right now, probably 45% or so, maybe a little more, maybe 47% of all federal tax revenues come from individual households and individuals. What's most noteworthy about this image is the next two. Corporate income taxes as a percentage of federal tax revenues have declined dramatically since World War II. You can see that probably 35% of all federal tax revenues came from taxes on corporations around World War II. Now it's probably closer to 10% or even a little less. So that's one of the two major changes in terms of sources of federal tax revenue over a almost 70-year period. Then the other major change is the dramatic increase in payroll tax. Payroll tax is the amount of money that individuals and businesses, individual workers and businesses pay for Social Security. Payroll tax is Social Security tax. And so this is a separate tax, different from federal income taxes, that that comes out of the check of most employees in the United States of America. And you can see that roughly, I have to look here, is maybe 30% of the entire 100% of federal tax revenue comes out of Social Security taxes or payroll taxes. And these are supposed to be set aside and not used except to maintain the Social Security program. The previous administration and Congress did not do that, meaning prior to President Obama, and that is not very helpful in terms of maintaining the financial viability, which is still okay, of the Social Security system. Now, the other thing to keep in mind that's very important about the payroll tax, almost nobody knows. I mean, the payroll tax is in a growing part, 30% plus or minus, of all of the taxes paid to the federal government every year. So here's the deal about the payroll tax. and it's something that President Obama talked about a bit in his first campaign, but has not been able to deliver on. The payroll tax for each individual has what's called a cap. That means that you don't pay payroll tax on any more than a certain amount of income. And that cap is raised a little bit pretty much every year. The cap right now is about $117,000 a year in terms of income. What does this mean? What it means is that workers who pay payroll tax in the United States will pay, anybody who gets wages or salaries will pay the payroll tax on the first $117,000 they make. Because there's a cap roughly at $117,000, any income or salary in a year that one earns above that is not taxed by a payroll tax. Simply put, what this means is that if I make $117 million a year and you make $117,000 a year, we pay the exact same amount in payroll tax that year. And if you want to see that, there are a couple things that are interesting about this. One is that if the cap were eliminated, as President Obama once proposed as a candidate, that would pretty much solve any question of the fiscal capacity of Social Security as far as the eye could see. The second thing that's interesting is there are a lot of people in American politics who argue that we need to simplify the tax code and we need to have a flat tax. Those people, I would suggest to you, are hypocrites. They're hypocrites and they're misleading you for two reasons. First of all, if you look at the tax system as a whole, state, local, and federal, what you will find is that we already have pretty much a flat tax system. I'm not going to go into great detail on that, but if you run the numbers, what you will see is that pretty much we have a flat tax system if you count all the taxes the American people pay. Secondly, what we have in the payroll tax is the furthest thing possible from a flat tax. A flat tax would be you pay the same percentage on whatever income you earn, however much you earn it. But if the tax stops at $117,000 and you don't have to pay if you make $117 million or $117 billion on anything over $117,000, then the percentage of tax you're paying goes way, 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 way down compared to the person who's making $100,000 or $117,000 or $50,000. So this is unfortunately both a very important and a very regressive tax. Regressive tax is one that taxes lower and middle income people at a much higher rate than upper income people. Any comments or questions? Who gets the tax breaks? This image looks at tax expenditures. So what is a tax expenditure? A tax expenditure is a provision of the federal tax code which forgoes revenue that the federal government would otherwise obtain. Example, and this is perhaps one of the most common and important examples of a tax expenditure. If you buy a home, and if you take out a mortgage, a loan, to pay that loan back over 15 or 30 years, every month and every year you pay interest to the bank or to somebody, whoever gave you the mortgage. Every month and every year you're paying a portion of your monthly payment as is interest. It's interest on your mortgage loan. The federal government, the tax code, allows taxpayers to reduce their income by the percentage of their taxable income, by the percentage or by the amount of interest that they pay. Maybe not the total amount, but there's a calculation that Lord knows is well above my pay grade. But the bottom line is the federal government will reduce your taxes every year if you pay interest on a mortgage. So that's really the most common, because more than 60% of American households own their own home. So these are, if that provision in the tax code didn't exist, then people's taxes would be higher. So, but that's just one of literally thousands of tax expenditures. Then maybe tax break or tax credit might be another term, but it's money that could be income and wages that could be taxed by the federal government that's not. So where do the benefits go? Well, it turns out that the wealthiest 1% of taxpayers get about almost a quarter of all the tax expenditure benefits from the federal income tax. The top 20%, that is to say, the richest 20% in terms of income and wages, receive about 2/3 of the tax expenditures, and the remainder, that is the other 79% of American taxpayers, receive only 34%, and the lowest income people receive only 3% of the tax breaks, credits, expenditures, whatever one wants to call them. So not surprisingly, at least in my view, the bulk of tax expenditures are used to advantage by far the wealthiest people in the country. I don't know if you're able to see this or not. This is an image of another image of what the federal government spends its money on. That's, again, spending. It's part of fiscal policy. And 26.5 cents of every dollar that goes to the federal government is spent on the military. 20 cents of every dollar is spent on health care. Together, that's 46.5 out of 100 cents, which is almost 50%. So, what do we learn from this? Well, we learn a couple things. First, we learn that if you look at the rest of the world, that no other country in the world spends anything even remotely like what the United States does on military and health care. Second, we learn, and again, those figures, those numbers aren't up there. You're going to have to take my word for that, but go ahead and do the research. You're going to find that I'm correct. So, the first thing it means in terms of domestic policy and in terms of fiscal policy is anybody who is at all remotely interested in reducing the federal deficit has to start at the top, not at the bottom. Transportation isn't going to do it. Foreign aid isn't going to do it. Energy and environment, education, housing, none of that's going to do it. It's too low. Anybody who talks about cutting the federal deficit and doesn't talk first and foremost about cutting defense spending and healthcare spending is full of you know what. Because you can't get there. It's math. Okay? It's simple math. And one of the purposes, though I have, like probably many of us, at best mixed feelings about the Affordable Care Act, one of the purposes of the Affordable Care Act that was passed in 2010 was to try to, and not the only one by any means, was try to reduce this 20-cent figure on health care. And it will take some time. Change in American politics tends not to come very quickly. So we should expect that if the law is successful, that over a period of years, maybe 10, 15, 20 years, that 20-cent figure will go down to maybe 17 or 18 or 16. I mean, that would be a smashing victory, at least in terms of cutting into the deficit in future years. Cutting defense spending which is more than 30% higher than in total than what healthcare spending is politically more difficult. So this is, again, another example of fiscal policy. This is where government is spending its money. One might note that if you talk to most economists, they will tell you that of all of these categories of expenditure, the one that least stimulates economic growth is military spending. Okay. Still dealing with fiscal policy, taxing and spending. Question is, when you if you raise revenue that's not equal to the money you spend, if you spend more than you take in, then you have a budget deficit. So this graph is a look at the budget deficit, both real and projected, over a 45-year period. Begins in 1980. And you can see that 4 years in the Clinton administration, there was actually a budget surplus, and that quickly reversed once President Bush took office. And in 2009, in the aftermath of the economic collapse, that's when the deficit was greatest, because the amount of economic decline was greatest in 2008. And so over the course of the Obama administration, you can see that the deficit as a percentage of gross domestic product has been reduced dramatically, more than 50%. This goes 1, 2, 3, 5 bars, and this goes 2 bars. So that means 3 of the 5 bars, or 60%, almost 60% reduction in the budget deficit as a percentage of gross domestic product under President Obama. And in the blue on the right-hand side of this image, you see these are projected budget deficits by the Congressional Budget Office. And projected, of course, means that they're estimates, they're guesstimates, they're not real. Though it's obviously that agency's best effort to estimate what the deficit will be. And there's another image of the same thing, the total deficits as a percentage of gross domestic product. Just another way of looking at it. This goes back to 1974. So what we can say about the current administration is that the federal budget deficit has decreased dramatically, but not completely, while President Obama has been in office. Why is that? Well, this is both a plus and a minus, depending on your point of view. Well, one of the major reasons is because federal spending under President Obama has been dramatically lower than in the previous 7 administrations. And so you can see that between 2010 and 2013, once the stimulus had been passed and implemented, that at least in that 4-year period, federal government spending was dramatically lower than in President Bush's 2 terms, even in President Clinton's terms, or in Reagan or Bush 1's terms. So one of the main reasons the deficit has come down is that the federal government increases in federal spending have been dramatically lower than in previous administrations. No one knows this either. Comments? So, okay, still on fiscal policy. All taxes aren't the same. There are different kinds of taxes. There are different kinds of activities or entities that can be taxed. And taxes don't necessarily affect different income groups the same, nor do they necessarily have the same economic impact. Some taxes are more likely to generate revenues from the very wealthy. Other kinds of taxes will end up affecting lower and middle income groups more. So one of the things I wanted to talk about was the federal income tax and the criticism of the federal income tax, and the economic significance and political significance of criticisms of the federal income tax, because this affects everybody. In fact, one of the reasons the federal income tax that we pay, presumably on April 15th every year, one of the reasons the federal income tax has become such a visible issue is because, in fact, it affects all individual households and taxpayers, individual taxpayers. So this makes it easier because everybody in the country, or almost everybody, is affected. It makes it easy. It makes it a more visible and viable public issue. Notice, just in contrast, states have things like they tax alcohol, they tax cigarettes, tax gasoline. But what's the difference? What percentage of the population smokes? Maybe a quarter. But how do you politically organize Americans who are smokers? It's very hard. They're not a majority. And many people, maybe more people than there are smokers, don't like smoking and know that it causes all kinds of health problems. These are called, what I'm talking about here is sin taxes, taxes on alcohol, taxes on cigarettes or cigars, for example. So the constituency that's affected by sin taxes is much smaller and harder to organize than those who are affected by the federal income tax and paying it, because almost everybody who works or who is related to somebody who works is affected by the federal income tax. Similarly, you pay, if you drive a car and you use gas in your car, you're paying some amount of gas tax every time you fill up. But you don't get a receipt that says, here's how much the gas is, here's how much the local tax is, here's how much the state tax is, here's how much the federal tax is. Most people, including myself, have no clue how much tax you're paying on a gallon of gas. It's totally invisible. Sure, you can go to the internet and find out what it is from one state to the other, but even if you did, even if everybody did that, the people who drive cars are not easily organized because, first of all, it's just a hugely diverse group of people. So what makes the federal income tax a powerful political issue, regardless of the policy implications, is simply that it affects almost everybody. Now here's the really interesting thing. The Tea Party folks and probably most of the Republican Party support what's called a flat tax. So whether you make $3,000 or $3 million, you should pay the same percentage. Now here's what gets overlooked. If you add in what Americans pay in all the taxes we pay, federal, state, and local, we pretty much already have a flat tax system. The payroll tax isn't a flat tax. Not even remotely close. Because anybody who makes over $117,000 in a year doesn't pay any tax whatsoever on anything above that. So what we have is remember, we have a federal system, okay? So we have federal taxes, and we have state and local taxes. And it turns out that the federal income tax is mildly progressive. It's less progressive than it used to be. Under President Eisenhower, the top tax rate was 77%, meaning, I know that's probably shocking to you. In other words, if you made like over $1 million or some ridiculous 7 or 8 figure salary, you paid at the highest income, on the highest marginal, on the marginal tax, the marginal dollar that you make, the very highest amount of the money you make would pay at 77%, not all of it. But that's double what it is now. So, but what we've had is a tax system that has two pieces, a federal and a state and local piece. The federal piece historically has been mildly progressive. The state and local piece, for reasons I'm not going to get into, has been somewhat regressive, generally. What this means is that federal taxes have tended, historically, to tax people with much larger incomes at higher percentages, people with lower incomes at lower percentages. It's just the reverse for state and local taxes. That's why when you take the whole system together, we have a relatively flat tax system, meaning that if you look at what economists do is they look at what's called quintiles. That is, they divide taxpayer entities into categories of 20% each. So the bottom 20, the next 20, the middle 20, the next 20, and then the highest 20. And if you look at the entire tax system, we have something pretty close to a flat tax system. So if what your politics incline you to do is to attack only federal income taxes, which are progressive, and you reduce those taxes, what you are doing is advocating a reduction in the progressivity of whatever is left of progressivity in the tax structure. And you are proposing policies which would shift more of the tax burden to middle and lower income people. So if all you do is say we need a flat tax system on federal income tax, or we need to reduce federal income taxes, what you in fact are doing is saying, quote, we need to tax people who make under $100,000 more and to tax people who make over $100,000 less, or meaning at lower rates. I know Fox News hasn't told you this, but any economist will. Okay, so this summarizes again the difference between a progressive tax and a regressive tax. A progressive tax is one where the rate increases as one makes more money. A regressive tax is one where those with more money pay a lower percentage of their income or wages or salary in taxes than those with less income. There's obviously a question of fairness, but there are also other questions, economic questions of economic policy involved as well, and we'll get into that mostly next time. So here on your left you can see the progressive taxes. Federal income taxes are progressive mildly. State income taxes sometimes are, but often are not. They could really be in either category. The federal corporate income tax is progressive, but many companies pay no corporate income tax at all. The estate tax is progressive, and the Medicare tax, and for that matter, the Medicare tax, as I know, unfortunately, this year, is progressive as well. Meaning, if your income is over a certain level, you pay more for as a Medicare recipient. Regressive taxes are Social Security, most state and local sales taxes, and local real estate taxes. So the ones on the right disproportionately hurt middle and lower income people. I think I'm going to stop here because this will take us into what a Keynesian approach to economic policy is, and we'll pick that up next time on slide 34. Any comments or questions? We have a minute or two left. Let me just say, I know probably some of the things I presented to you this morning may seem contrary to what you might have heard, and all I can say to you is that I don't make stuff up. I believe very much in evidence and facts and research, and if you look at the research and you look at the numbers, you have to come down on the side of
Please, there's a Renaissance Peak Leadership meeting in
what reality is rather than just making stuff up. Any comments? See you next time.
Bye.